Ahoy there and welcome back. We're still applying rule number 1 and we're still applying it to large accounts. Now that we've created our universe of stocks, what we can start to do is to scan those stocks. And again, as we've already mentioned, this is great for larger accounts. You don't have to only do this if you've got a large account. As we've mentioned previously, if you want to apply the small account trading style to a large account, you can do that. One of the differences as we move to a large account is that we have freedom of choice. So I'm going to apply a get paid monthly strategy using daily charts, and I'm going to still use the shorter term get paid weekly strategy, but I'm going to use that in addition to add in and compound into movements should they run favorably. So it's the same setup, the same strategy, but only now that I can apply both of them in the same way with the basically the hunting version of the strategy. However, if you just want to apply the get paid weekly, what we're now going to use as the add-in to a large account, then you can do that. Again, which one is right? It really comes down to your particular preferences and your situation. As we continue to say, there's no single right or wrong answer. I'm just trying to show you where the choices that can be made are. Anyway, for this purpose, we're going to assume that you're going to create a large portfolio, you're trading a large account, you're going to swing trade monthly using the daily charts, and we're going to add in and compound to those trading opportunities using the same strategy on a 60-minute chart. Again, the add-in part is optional, as I've just alluded to. If you don't have time to do it, don't worry about it, but the choice is there if you want to do it. And it's the same strategy that we use with the small account strategy, so just showing that there's no real difference. The scan part for the add-in is literally just to look through your open positions, and there's a few criteria that we look at later on, so we don't need to worry about it right now. What we're looking for is to apply rule number 1, find something new to trade. So ultimately, we want to scan. Now, what I'm going to do is I'm going to use indicators to take a big list of stocks to a small list of stocks. And this means that I don't have to look at every chart every day all of the time, because I've got a universe of about 500 stocks. I don't want to look at every chart every day all of the time. It's a pointless exercise. I want to be able to zoom in on the 2, 3, 4, 5 stocks that I only need to look at today. It doesn't mean that I'm going to trade them all, but they're the only ones that I'm going to look at. So before I look at a chart, I'm going to scan, and that's what indicators are best for. I just want to be very clear at this point. They are not signal generators. They're not doing anything clever or creative. All they're doing is taking the brunt of all the heavy lifting so that we don't have to spend hours looking through charts. That's the best way of thinking about these tools and indicators. The clue's in the name. They indicate. Anyway, so rule number 1, scan. Take a big list of stocks to a small list of stocks. I'm going to use Bollinger Bands and bars with spikes. So that's like a hammer, a doji, a shooting star, if you want to put the proper name for them. I generically bracket them all as having a spike. Okay, we'll come on to the definitions in a bit more detail in a moment. Ultimately, Bollinger Bands, they allow me to find a deep pullback. Again, we'll come on to that in a moment. But ultimately, I'm looking for price to have moved to a Bollinger Band extreme. That's one way of scanning for stocks. It doesn't necessarily mean that price is going to reverse or continue. It just means that it's at an extreme of its movements. And as such, that makes it interesting to me. It's nothing more and nothing less than a way to filter a large list of stocks to a small list of stocks. And that's all I'm using it for. I don't care that price is there or it's a particular line in the sand. It does not matter to me. I just want to re-emphasize and stress this point once more. Any indicator, in this case we're talking about Bollinger Bands, it's just a way to take a big list of stocks to a small list of stocks. It just is at the Bollinger Band high or the Bollinger Band low. The fact that it's there, or price is at either the upper or the lower band, that's all I'm interested in. I'm not trying to interpret it in any way, shape or form other than to say it's at that point. Mathematically speaking, it's at 2 standard deviations, and it's as such at an interesting location. That's it. Don't look any more into it. Now, we could be using any indicator, but ultimately it's the Bollinger Bands. One thing that I have learned, random little sidebar as I'm kind of thinking about this, one of the things that I have learned after more than 20, I've been doing this since the mid-90s, after more than 20 years of doing this, the one thing that I have learned is that the indicator does not matter that much. All I'm using it for is to take a big list of stocks to a small list of stocks on a regular basis. What is actually more important is price action. So the reality is number 2 there, bars with spikes. That's more important to me than the indicator. I can use any indicator to take the big list to the small list. But price, that's going to determine, am I going to take action today? So most of the time, I'm looking at bars with spikes, because for me, that second step is, that's going to determine if I'm going to put the trade on today. And one of the things that we'll see in a moment is that more and more frequently, and the longer I'm doing this, I'm often just looking for, does it have a spike on it? Because if it has, and as long as everything else is in place, then I'm probably going to trade it today. There's no guarantee, but obviously it just gives me a shortlist. So if we use them in conjunction with each other, prices at a price extreme, at least statistically speaking, in reference to the indicator that we're using, and it's got a sign of exhaustion, a bar at a spike on it, as long as everything else is in place, then I'm probably going to trade that today. So that's important for me to know. Now, at this stage, all we're doing is applying the rule number 1. Scan is the first part of that. So we're at this stage looking at any charts, and you'll see that in just a moment as we go and look at the charts. Okay, so now that we're looking at the chart, one thing that I'm looking at is, firstly, I am not looking at the charts yet. I'm focusing all my attention over here on the left, and I've got the Bollinger Band in a table form. Let me just put the Bollinger Band on so we can actually see what it looks like on the chart. So I'm going to look at Bollinger Bands. Let me just get the right one on. Click the wrong tool. There we go. Okay, so this is the standard default settings of the Bollinger Band. And what we're looking at, or what we're looking for rather, is when price, or what the upper bands show. What this essentially is, it's a mathematical calculation that is a measure of standard deviation. So there's 3 bands. You've got the upper band, you've got the lower band, and you've got the center point. Now, the midpoint, the center band, is essentially a 20-period moving average. There's nothing fancy about it. But then what it does, it takes the calculation for standard deviation and it multiplies it up and multiplies it down. It runs its calculation, does whatever it does. We don't need to know the calculation, but it does it for us these days. And it plots the upper band and the lower band. So that is, mathematically speaking, 2 standard deviations from the moving average up and down. And that's what essentially the upper and the lower band is. So mathematically speaking, 95% of the price points or price movement should stay inside of the Bollinger Band, because that's what 2 standard deviations is. That means that 5% of the time, price is outside the Bollinger Band. So when price is outside the Bollinger Band, it's doing something unusual, something that it doesn't normally do. And that's the key point there. It doesn't normally do it. So when it does that, again, we can see a good example here. When it does that, when it closes outside the Bollinger Bands and does something that it doesn't normally do, then there's a good chance that that will provide an opportunity. So what I've done is I've just highlighted 3 or 4 of the instances that are really obvious. Price has closed outside the Bollinger Band, and it did something interesting afterwards. Price closed outside the Bollinger Band. It did something interesting. You can just see it there. It did something interesting. Closed outside the Bollinger Band. It did something interesting. Closed outside the Bollinger Band. Okay, it didn't do it there. So it doesn't always work. I'm just trying to highlight the obvious. But what we can see is that, price, when it closes outside the Bollinger Bands, it normally does something interesting and funky afterwards. Now, it could go up or continue to go up, or it could continue to go down, or it could reverse. I don't know. We're going to do all of that filtering later on with the other rules. But for now, I'm just explaining what is actually happening. So that's what I'm looking for. I'm looking for a time where price has closed outside the Bollinger Band. But I'm going to do it over here on the watch list so that I don't have to look at every chart all of the time. So what you just sort of, maybe I did that a bit too quick. Let me just go back. Okay, so they're all sorted alphabetically for the moment. So over here on the left, what I'm doing here is this column. That is the table version of the Bollinger Band. Now what it does, it's actually a different variation of the same indicator. It's called percentage B for reference. So I've inserted the percentage B indicator into the watch list. And what it's going to do is it's going to tell me where price is in relation to the Bollinger Band. So let me just get a different chart on. So it's going to tell me where price is in relation to the Bollinger Band. So if the upper band represented 100 and the lower band represented 0, it's going to tell me where price is in relation to that scale. So it's going to be on a scale of 0 to 100. It can go above 100, it can go below 0, and that's what I'm interested in. When it's above 100, that means that price is outside of the Bollinger Band. Or when it's below 0 and showing me negative, then it's outside of the Bollinger Bands, and that's what I'm looking for. That's these times where price is doing something interesting. It's doing something funky, something interesting, something exciting, something that it doesn't normally do, and that means that that might provide an opportunity for me. And we're going to do it over here on the left, so that I don't have to do it by looking at every chart all the time, because I don't want to look at 500 charts. So watch what happens. There's the Bollinger Band, the percentage B, and this is how we scan. Double click, in my case, that's how my platform works, and now it's taken 500 stocks, and these are the 10 stocks that are at the lower end of the Bollinger Bands. So I don't have to look at every chart every day all the time. I've found 10 stocks that I need to look at, and they're the only 10 stocks that I'm going to look at. Now, it's at this point that I can start to look at the charts. And conversely, if we sort them the other way, these are all the stocks that have closed outside of the Bollinger Band. And you can see that on occasion, lots of stocks do move above the Bollinger Band. So this is where that second part of the scan comes in. So if I'm looking for a spike, so a spike for me is a bar or a candle with a small body and a big spike. A small body and a big spike. And that could be 1/3 body and 2/3 spike. That's typically the ratio that I'm looking for. So if I look down that second column, and all I'm going to do is look down, I can look down. I'm looking for a bar with an indication that says it's a spike. If you want to put labels on these are hammers, these are dojis, these are shooting stars. I've had this particular tool custom coded, but a lot of platforms come with them built in. I've just bucketed them all together and say, I just want to know if it's got a spike on it. That's all I'm interested in. Now, if it's got a spike on the upper portion, I'm going to call that a bear spike. If it's got a big wick on the lower portion of the candle, I'm going to call that a bull spike. And that's what I can see over here. So now that I've done that, I can see that I'm at the upper Bollinger. So what needs to happen here? Now, we're not looking at any charts yet, but what needs to happen for price to be at the upper Bollinger Band? Price needs to have rallied to be at the upper Bollinger Band. Because I know, and I'm going to evaluate direction, which we'll explain later on in the process, I know, for example, for price to rally, I'd like to sell a rally in a downtrend. And if price is at the lower the Bollinger, it must have sold off. So if price is at the lower the Bollinger, it must have retraced or dipped. And ideally, I'd like to buy the dip in an uptrend. We'll explain all of that later on when we come on to the evaluate direction part. But I know what I'm going to do next. So that's what this is telling me. Again, keep in mind that I'm still not looking at any charts. I'm just trying to visualize what is happening on these charts. So if all of these stocks, and there's 50 or so stocks here, that have rallied in, I don't know if they're in a downtrend. We're going to visually check that later. But that's what these stocks are doing right now. They're rallying at some points. Now, am I going to trade this today? So if price is rallying in a downtrend and I'm looking to sell it, am I going to sell it today? So if we're at the upper Bollinger Band, then I'm looking for a bear spike. If I'm at the lower Bollinger, then I'm looking for a bull spike. It's that simple. So now I can take that second filtration and say, am I going to trade it today? So if it's retracing in an uptrend, am I going to trade it today? If it's rallying in a downtrend, am I going to trade it today? That's what I'm looking for. So that's what this second chart is. So as we look down, while there's 50 stocks that have, or there's 48, that have rallied and closed outside the Bollinger Band, none of them have shown me a sign of exhaustion with a bear spike. So I don't need to worry about that. So again, still not looked at any charts. Now, these 10 that are at the lower end of the Bollinger Band, these are stocks that have closed outside the Bollinger Band, and there's only one here that has shown a sign of exhaustion with a bull spike. So that is the only chart I need to look at today. Now, there's a few that are close here. We can see that this one's got a bull spike, that one's got a bull spike. You don't have to restrict yourself to stocks outside the Bollinger Band, but it just means that, hey, price has sold off. It's got a sign of exhaustion. Assuming that everything else is in place, there's a good chance that I could possibly trade that today. And it's at this point that I will then go to the chart. So the first part of the scan, or first part of the strategy, is to scan, and this is how I scan. Find something to trade. I can use the Bollinger Band to determine, is it doing something interesting and funky? It's at a price extreme, and then try and determine, am I likely to trade it today? Now, as I mentioned earlier, what I'm starting to do more frequently is just sort the stocks by spike. It will give me a little bit more choices in this particular case. It doesn't take that long to go through them. But, you know, that is something that I do find myself doing more and more. And to be fair, going through this number of stocks, it probably take about 5 minutes. It's not that labor intensive. But ultimately, that's one of the things that I'm doing. So again, we do have that two-step approach for the scan. Find the Bollinger Band price extreme, and then go and look at the chart, and then we're going to determine direction. You'll notice that I'm intentionally not clicking on the chart, because that's the next part of the process. All we've done at this stage is scan and find something to look at. And that's what we've done. I found one stock today, and maybe there's... so we've got this one here. Maybe there's a second and a third and possibly a fourth stock to look at, because, you know, there's not that many opportunities that are outside or near the low end of the Bollinger Band. So I've got something to look at. I've got at least one and possibly 4 stocks to look at today. The reality is I don't know if I'm going to trade them, but should everything else be in place, there's 4 possible candidates that I could trade today. We'll look at the next part of the process of determining the trend and evaluating, will I be trading it? We've already talked about it. Buy the dip in an uptrend is one of them, and that's what I'm expecting to see on these 4 stocks for the moment. I'll see you on the next installment, and we'll look at the next part of evaluating the trend.